Hello, I'm Jason Kelly. Thank you for joining me. In this video, I'll look at whether smart beta funds are worth their higher cost. Smart beta funds have become very popular recently. They are based on the idea of taking a cheap index fund and then applying some basic filtering to the types of stocks it owns to try to replicate what hedge fund managers and other more expensive forms of active management are doing to try to find winning stocks in these indexes. Here's how the funds were explained in a March 18th, 2017 Buttonwood column in The Economist. The best argument for smart beta funds is that they simply replicate, at lower cost, what fund managers are doing already. For example, many fund managers follow the value approach, seeking out shares that look cheap. A computer program can pick these stocks more methodically than an erratic human. A smart beta fund does what it says on the tin. While it may be true that smart beta funds are cheaper than active managers, it's important to remember that active managers don't beat their indexes anyway in the main. They usually lose out, which is why more people are switching to plain, super cheap, nothing to them index funds. So the more relevant question is not whether smart beta funds are cheaper compared to active managers who are not worth the money anyway, but whether smart beta funds are worth the extra cost they impose on top of the plain indexes they attempt to improve upon. So let's look at that more relevant question. We'll use the Russell 1000 index. This is an index of the United States stock market that takes the 100 largest companies from the Russell 3000 index of the entire U.S. stock market. Think of it as an S&P 500, but with 1,000 companies instead of just 500. So 1,000 large companies in the United States. Now, you can own this index as just the plain index by itself from iShares. The symbol is IWB. Its smart beta growth version uses the symbol IWD, and the smart beta value version uses the symbol IWF. Okay? Now, by the way, this growth and value automation, the way it's automated in the algorithms is they will take traditional measures of value, traditional measures of growth, and instead of having a human being comb through a database of stocks looking for a low price to earnings ratio or a high growth rate or something like that, the algorithms do that. So it's essentially a stock filter that's applied to the index and run. And in this case, with the Russell 1000, we have a value version. That's the stocks that are meeting the value criteria, and the growth version, comprising the stocks that meet the growth criteria. So those are the three variations on this one index. Let's look at their expenses using Morningstar. Notice here, the plain index at the very top of the list here, IWB, has an expense ratio of 0.15%. The value version, symbol IWD, right in the middle. Excuse me, let me make sure I get this right. Yes, the value version, IWD right in the middle, 0.2%, and then the growth version at the bottom, IWF, 0.2% also. So both of the smart beta versions charge 33.3% more. It may seem like a small difference going from 0.15 to 0.2, but it is a 33.3% increase in expenses, which adds up over time. So we have to come back to the question, is it worth this added expense to go with a smart beta fund? Let's have a look. Here on a comparison chart from Morningstar going back 1 year, we see that they've all ended up about the same. They almost look like variations of the same line, which they are actually. Remember, it's all based on the same index. And they ended up at about the same place. So over this past 1 year period at least, it has not been worth paying the extra money for a smart beta fund. But of course, 1 year is not representative. So let's go back farther. Next chart, also from Morningstar. You can see them starting to diverge in about 2008 after the crash. The recovery from the subprime mortgage crash saw some divergence among their returns. Which one was the clear winner here? The main index. The main index did considerably better than both of the smart beta variations. So people who just stayed in the plain Jane, no modifications, nothing smart about it index actually did much better than people paying through the nose for the smart beta versions of the index. But that's not the whole story either. So in the interest of fairness, let's go out as far back as we can go, all the way back to the year 2000 with this grouping. In this run, value came out ahead. What do we conclude from this? Basically, that you don't know which one's going to come out ahead on future time frames Because of that, and because one of the ones that sometimes wins is the plain index, I recommend rejecting the whole notion of smart beta, paying as little as possible for main benchmark unmodified market indexes and letting them do their thing. There's enough volatility in the plain old market index line for you to buy and sell as things go up and down over time if you react to price changes alone, which you would do if you're following my system, and there's no need to pay extra for these smart beta funds. So that's my recommendation. Have investors listen to this kind of advice? Absolutely not. How do we know this? Because of assets under management. Currently, the main Russell 1000 index fund has only $18 billion in it, whereas each of the other two has about twice that, $36 billion in value and $34 billion in growth. Other people are ignoring this advice. You should not. I recommend that you stick with plain old indexes the way I do. They will serve you just fine. Thank you for watching. I hope this has been helpful to you. Please like it on YouTube. That'll give it a boost in the algorithm there. And if you are not a Kelly Letter subscriber yet, I would love to see you on the list. If you are a Kelly Letter subscriber, I will see you on Sunday.